We'll get going here. So my name is Natasha Phipps. I am the CEO of WealthShare. And tonight we have a topic that we're actually really excited to discuss and address. I know in the marketplace right now, there's been a lot of volatility in all sorts of different ways in the last year. And so we wanted to kind of take a very specific topic here related to private securities and passive investments, and how can we as investors think about suitability and assessing our own risk. So that's what the point of this event is, whether you're watching the recording or you're here with us live. This is a topic that we feel really passionately about, and so want to continue to share along the way and open up these types of conversations as well, in case you're not sure where to turn. We're here and happy to have those conversations all the time. So tonight, I'm joined by my WealthShare partner, COO, Rodney Phipps is here this evening.
Hello.
And Ryan, am I going to say it right? McInerney? No, McInerney.
Just like Bert and Ernie, Mac and Ernie.
Thank you. I realized before we started, I should have called you and made sure I had that right. And Ryan is a really important member of our team. Ryan is with RealShare, which is one of the exempt market dealers that we work with. And so they have a very critical role over at RealShare, onboarding our investors, ensuring suitability, the topic of this evening. So thanks so much for being here, Ryan.
My pleasure. Thank you for having me. It's great to be here.
Yeah, it should be good. So kind of what you can expect tonight, what I thought we would do was we have kind of some Q&A that we would go through, just general questions that I know we get, and I'm sure you probably get as well, when it comes to these private type of investments, passive investing. They're common sort of things that come up, but point to some really important facts. But before we kind of get started, Ryan, maybe tell us a little bit more about yourself and kind of what you bring to, obviously, this space here in Canada.
Yeah, sure. Born and raised in London, Ontario. 2007, I gave up the lifelong dream of playing professional golf and thought I wanted to join the family business. And so that's what I did. My father's been a financial advisor for 45 years now. 2008 was my full first year in the financial services industry. And by the end of 2008, I realized I wanted nothing to do with the family business. I just couldn't connect with the public markets. It just wasn't for me, too volatile. Some might even say too manipulative. Anyways, I wanted to find my own niche within the space, and so I did that. I found real estate, or should I say, real estate actually found me. A few of our more affluent clients wanted to invest in real estate, and back in 2008, 2009, we didn't have things like RealShare or these other EMD platforms. You couldn't go make a real estate investment, at your fingertips. We didn't have these incredible marketplaces. So, I did like most folks are doing here. It was trains, planes, and automobiles, going to seminars and meeting developers and issuers. And long story short, started to put our clients' money into real estate in early 2010. 14 years later, I've been with a couple of different EMDs now. I'm now VP of Capital Investment and Senior Investment Advisor at RealShare. And basically my role is just that. I work with hardworking Canadian families. I've got my own client base, folks that are looking to invest in passive real estate offerings. And then over at RealShare, I'll work with great issuers like yourself who want me to go through suitability and KYC and KYP with your clients or some of your prospects and your leads, and kind of go through the do's and the don'ts and why you should and maybe why you shouldn't. So I wear multiple hats. I do serve my own client base, but I'm also there just to help the general public when people are looking at different issuers on the platform.
Awesome. So that kind of timeline too brings you through lots of different market conditions and the ups and the downs and everything in between, which is really, really good experience that I know that you bring to the table. Thanks for reviewing that. I think even there you had mentioned a few acronyms, and this whole space of real estate investing, the acronyms can become quite overwhelming, but we'll dive into those. But first, let's start with the most basic one is what is an EMD? What does that stand for? And what does that mean when people hear that term?
No, great question. Exempt market dealer is what it stands for. The easiest way for me to describe it is kind of think of it as a real estate brokerage. You've got your license.
Yeah.
You have to place that license somewhere.
Yeah.
Just like myself, I can't be standing on the street corner with a trench coat selling real estate investments and standing on my soapbox. I need to be licensed. I need to continue education to carry that license, and I have to place it somewhere. So, where real estate agents will place their license with a Century 21 or a Remax or whoever that may be, same thing. I place my license with RealShare. So, first thing they do is they stay on top of dealing representatives and advisors. They make sure we're up to date with education and licensing. So they serve us in that sense. The other thing they do is they look out for the investors themselves. So we walk through, the topic of tonight's suitability. We go through know your client, which is KYC. If you hear us say KYP, that's know your product. So again, they're regulating dealing reps, making sure we know the product as products are getting updated. So we facilitate the trades on behalf of the issuers, somebody like yourself, and also the investors. But last but certainly not least is we regulate the issuers. And that's super, super important. And our primary focus is twofold there. One, we need to make sure we protect the investors at all costs. So, you can't just show up, write a check, and jump on an EMD platform, or at least not our platform. As you guys know, we do significant due diligence for anybody who wants to come onto the platform. We vet all the partners and the deals, and we kind of go through things top to bottom, but we're also there to protect ourselves. And I say that from a selfish perspective because, there's some folks out there, real estate investors, that, investing doesn't always go well. And if done
Just
properly,
taking screenshots.
oh, sorry.
I think that was an accident.
Yeah, no worries. So selfishly, we want to protect the EMD as well, because, if real estate investing has its ups and downs. People potentially could lose money if done properly, done a suitable amount, and there's always a chance for recovery. But if an EMD gets that wrong on their platform, the likelihood of them being able to raise capital going forward is almost zero. We don't really get a bounce back opportunity. So yes, we look out for the investors, but we also look out for our business as well. And that's why the due diligence is so rigorous.
Yeah, that makes a lot of sense. I know sometimes, and the reason these conversations are so important, it's because, we talk to people all the time, and then they can kind of feel like they're getting maybe passed off to some other organization. So it's really important to understand that the EMD is there for very good reasons, to protect you as the investor, to have another set of eyes, to have another, vetting process on the issuer or the company that you want to invest with. So I think that's huge.
That's a great point. I mean, a lot of issuers sometimes do choose to go the path of becoming their own EMD, and it's extremely time consuming, and it's not a fun business. You're constantly dealing with the regulators, the OSC, and the governing bodies, and it's a big time burn. It's a different business where, we exist so you can focus on what you're doing, is delivering for the investors, and we just make sure you're doing that. And at the same time, we kind of take the headache work away from groups like yourself, and just let you focus on growing the business and generating great returns for your clients.
Awesome. So from the investor's perspective, me as the investor, the EMD, let's just kind of point out, like, very clearly and concise why the EMD is so important to the investor from their perspective.
Yeah, at the end of the day, it's all about protection. It really is. Again, it goes back to what we talked about just the first time there. If you're getting passed off to us, not anybody can just facilitate that type of a trade. It does have to be a licensed dealing rep or an advisor, such as myself, and we get vetted by the EMD. You get vetted by the EMD. There's a lot of interesting stuff in the market right now where people are taking subscription agreements directly into general partners. Everybody and their uncle wanted to start a fund in the last 2 years, and we're just now starting to see the fallout from some of that. And guess what? They weren't found on an EMD shelf anywhere. And there's a reason why. They probably wouldn't have passed through due diligence as, an early stage startup. Not to say that they can't be successful, but I'm just saying the whole point of the EMD is to vet and protect. And so if you're an investor and you're going through an EMD platform, you can rest assured that there's been, whether it's ours or the competitors, due diligence has been done on that investment and on that issuer.
And another benefit too is, like we use RealShare as a service, but you are not an employee of ours. Like that's a very different thing too. Like that is another benefit I think that's important to point out. And you're not just solely, raising capital or supporting issuers for WealthShare. Like there's a plethora of things that you can steer people towards that might make more sense for them. So in that, this is the next question that comes up all the time, and people see this, advertised everywhere, accredited investors versus eligible. And we get a lot of questions on that. A lot of people don't know what that means. Where do I go to get accredited? How do I do it? That's questions that we get. So let's talk about that. What is an accredited investor, and these kind of definitions that people see, and what do they mean?
Yeah, this is a frustrating one, and it's generally based on assets and or combination of income. Let's start with accredited, and I can just kind of give you the numbers of what's required to be considered an accredited investor. You either individually need an income of $200,000 a year for the last 2 years, or $300,000 a year combined with your spouse or your partner, your household income. Or $1 million of net financial assets. So not including your principal real estate. So we're talking about your investments, your cash savings, could be mutual funds, could be other alternative investments. So just your financial assets. And then the last qualifying point would be $5 million of net assets. So basically your net worth. So include all of your assets. It could be vehicles. It could be all of your real estate portfolio minus any liabilities. Above 5 million, that would qualify you as accredited. And on the eligible side, it's the same idea. It's just smaller numbers. So the income threshold to be considered an eligible investor is $75,000 individually, or $140,000 with your spouse or partner or household income, or $400,000 in net assets. So again, you can include your real estate holdings, minus any mortgages, liabilities, include all of your assets in that. And this is frustrating because, there's folks out there that might be making $189,000 and have $800,000 in net financial assets and a net worth of $3 million, and they can't access certain real estate investments, and in one sense it's almost deemed as an educational thing, and they treat it like, oh, just because you have money you must be a savvy or smart investor. Right. And that's not true, and that's super frustrating. But really what they're trying to get at is you would have the ability to recover from a possible loss better than somebody with lower income or lower assets already in place. And people often get offended that I can't invest just because I don't make this much money. And 10 years ago, 15 years ago, when I got in this business, none of that existed. You could write a subscription agreement with a penny in your pocket and invest in just about anything, and people got hurt. People got burned. So I think it's a good thing. Yes, it's frustrating because sometimes we can't get good people into certain deals, but again, the OSC and the regulators put it in place to protect the investors at all costs, and that's basically why they put that in place.
Yeah, I'd like, you'll hear me talk about this a few times. I think sometimes people treat the status like it's an achievement, or you get a certificate in the mail or something, or there's something that now you can hold your hand up, but it's really almost the opposite. This is what you can afford to lose. You have now entered a market where you can just lose more. I don't know if that's necessary. Like, you could look at that like an achievement, but like you said, it's a recovery, your ability to recover a loss. And so, like, I think that's also important when people are looking at it. It's not something that you need to consider as like this milestone necessarily. It's just there for protection. And that also goes to why we went the extra mile to be able to offer ours to eligible as well as accredited, because we felt like we have this nice balance of being a little bit more of a, a safer investment. So it's like a good entry point investment where you're not taking this huge swing, but you can do it at an earlier part in your investing, right? And it be part of your education, right?
That's a good point.
Yeah, good point. Thank you. Okay, so kind of as an extension of that topic, that really speaks to suitability, right? Your risk tolerance, but then also individuals, when they have meetings with you, like let's talk about the kind of questions you're asking them, the types of questions the platform's asking them, because how I might answer and how you might answer might be very different. So let's talk about that, how an investor might expect to kind of have these suitability questions when they work through an investment with an EMD.
Yeah, I think that's a great question. Our platform is all done digitally. As you know, you can go in and open an account for free on RealShare, and you'll go through, you'll answer 14 questions based on kind of suitability, and there's algorithms in place. But I always like to go through this process with our clients, because even those questions are, the way the wording is put in place, it can be a little bit confusing and daunting. So I like to do some hand holding there. The main purpose of suitability is just to make sure folks know, what they want, what they can tolerate, what they're after. Every issuer, every offering on our platform has what's known as, in our situation, KYP, know your product. And it's always going to be based on, a risk level, liquidity, timelines, concentration. And so what we do is we ask a series of questions to find out, how long do you want to hold your investment? 3 to 5 years. How much would you maybe be willing to lose in a down market, a percentage of your portfolio? Or from a concentration perspective, people want to say, oh, I want to put 50,000 and I love this, but we're regulated to try to keep people around 10 to 15% of net financial assets. So it's funny what people want, and then how they answer the question sometimes just doesn't align with the know your product associated with that particular investment. And it becomes an emotional thing. And the purpose of this is to bring it down to say, well, you just told me you don't want to take any risk. You only want your money in there for a year. You can't afford to lose anything, but you want to put all your money in a land development deal that's going to take 7 years, is on the higher end of the risk, but you fell in love with the ROI. So the purpose of suitability is just to ask some very black and white questions and try to figure out if the investment and the goals of the investor are aligned by removing the emotion from it.
Yeah, that's huge. And also looking, obviously, what else do they have in their portfolio? Like, speaking of development deal, if all you have is development deals, you might not have a very diverse portfolio, right? So I think that answered my next question really, really well. But something that we talk about a lot is diversification across all things, right? In strategies, locations, the amount you invest, the type of issuer it is. Like, there's ways you can get diverse to reduce your risk in one certain category.
Yeah, that's one of the things as a more of an advisor for myself, that I think diversification is key. I think that's the number one most important thing to offset any risk. Like, don't get me wrong, there's always going to be risk in every real estate deal that you look at. It's funny how many times clients come to me and say, I'm well diversified. I'm like, well, how so? It's like, well, I did 6 different development projects with this issuer, so I'm in 6 different projects. It's like, well, no, it's still the same executive team. It's still the same type of investment, the same asset class, and they're all in the same province. So you're actually just taking way more risk if something happens to that CEO. Or so, there's so many ways to break it down. Sure, you could do a development deal, but you could look at debt, you could look at equity. There's so many ways to diversify within real estate. And that's also part of the power of what you're doing. This is what makes WealthShare and the REIT so powerful and so de-risked, is you're already taking that one step for, and it's not just one asset. You know, you're diversifying inside the fund across many, many assets. So you're already doing what I'm doing as an advisor in the space, which is spread it out. You know, if you want to put $100,000 in the market, great. Why don't we do 4 investments of $25,000 and spread it out and really de-risk this thing?
Yeah, awesome. Did you have something to add, Rodney? I wasn't sure if I just
No,
interrupted
I'm
you.
just nodding in agreement. I just, that's a lot of what we talk about a lot, like even when Ryan's not here. And you know, even from the WealthShare point of view, when we're talking to potential investors, it's like, we know that WealthShare should be a portion of your portfolio. And we talk about it being the boring part maybe, but it's just as important to be that part as well as the, you know, the higher risk stuff. They should all have a place in your portfolio, but there should be a balance of them, right? And so when we talk to investors, that's why we like working with like RealShare or some, you know, an issuer like you, like having these options, having an investor take a look at what we're doing, and then also understanding this should be part of how you plan the next 5 years of your investment career, so to speak. So.
Ryan, we just had a question. It just came to me privately. I hope you don't mind me reading it. I don't think you do. I know you personally pretty well. I won't say your name just in case. But the question is, I'd like to invest through my corp. Are personal accredited investors qualifications different from business qualifications? Is the process / paperwork different from personal, or is it similar?
No. So you have 2 ways to qualify that. Either the corporation has to have $5 million of net financial assets inside of it, or whoever the primary shareholder is of the corporation. If they're accredited, therefore the corporation is accredited as well.
So it has to be accredited status.
No, we can still do, and it's rare, but we can qualify a corporation as eligible. The corporation is going to follow whomever the individual or the primary shareholder is of that corp. However they qualify, we can also get the corporation qualified.
Great. Yeah, really good question. We should actually, I feel like that one's been coming up a lot for us recently. So good question. Thanks for asking. So when you go on RealShare or other EMD platforms, there's obviously lots of different options to look at. And I've heard from investors, it's kind of overwhelming. It's like, how do I know the difference? Even like REITs, like, you know, that are doing similar things that we're doing. Like, how do you compare what, you know, what key things should I look for? First, I'd like to maybe get your thoughts on that. Like someone first going to look at that. What should I be looking for? How do I compare these things? Obviously returns are the first thing everybody thinks about, but there's a whole kind of series of things to compare to.
This is great and it's super relevant. We were just at the multifamily conference together, obviously, with RealShare and WealthShare and a few other issuers from the platform. 2,000 people walking around, and I feel like I got that same question, was just, where do I even start? You know, there was probably 20 active deals on the floor there. They all look the same on a glossy piece of paper, and it's, how do I narrow this down? I mean, first and foremost, you need to identify a goal, an investment objective or a goal. What do I want to do? Am I looking for cash flow or am I looking for growth? Because that's going to steer you in one direction or the other right out of the gate. Then what I do is I have 5 simple questions that I've always used since I've been in the space. And they're just common sense questions that you can start to do some Google search with. And what you want to do is narrow the list down from say 20 to that 3 to 4 or 5. So when you go to do some proper digging and due diligence, it's a smaller list because we just don't have time to try to go through 20 and do a full deep dive. So the first one I always consider is market. You know, where is the project or where's the fund mandate or criteria? In your situation, Alberta. And then, you know, what's happening in that local market? Where is this project being built or where is it being bought? Is the population growing or is it diminishing? What's happening with unemployment? Is city council pro-development or are they not pro-development? So you just want to find out what's going on in that local market. Is it primary, secondary, tertiary, just to get a feel for what's going on at kind of the macro level in the market. The second one I always look at is execution, because you could have a great project and you could have a great market, But if the team can't execute, then you know right there. So, you know, if they've never done it before, if they come to you and say, well, we're going to do and let's just stick with development for the sake, because that's normally the most daunting one, you know, a 40-story condo and they've only ever done 6 stories and this is going to be their first one, you might want to question, you know, execution. Are they biting off a little more than they can chew? Again, you can find this out. It's simple due diligence. You can do Google search. You'll talk to DRs like me. We'll know corporate history and what they've done. You want to find out pedigree. Who are the people behind the deal? Because a term sheet or a subscription agreement has never got anybody out of a jam, but good people always tend to do that. So it's real estate. You're going to go through bumps. Let's face it. So the execution team's critical. Third thing is the project. Does the project make sense for the execution team and also for the market? You know, is someone trying to put up 6 stories, you know, 6 towers, 1,200 units in a town with 50,000 people, where net migration has been down the last 2 years? No, that doesn't really make a whole lot of sense.
Yeah.
So again, just common sense stuff. Does the project fit the builder, the developer, the GP, and does it fit the market? The fourth and probably the most important is risk. Again, there's risk in everything. So what are they, and what has the sponsor or the issuer done to mitigate? And you guys know there's lots of great things you can do in real estate to offset risk. You can, you know, subordinate behind your LP investors. You can move land titles or property titles into the possession of a nominee corp that the LP controls or owns. You can use land as collateral. You know, you always ask the question, well, what have you invested alongside of me? If it's so great for me, what have you put in the deal? Again, it's all going to be in an OM, or it's all going to be in a pitch deck. So just find out what the risks are and just what's been done to offset those. And then last, and in my opinion, certainly least, is the ROI. And I say that because if 1 to 4 don't bring you comfort, then the ROI does not matter. They can be promising you a 10x in 3 years, but you know, if the market doesn't make sense, it's the first time doing this thing, the project just seems off for the market and the builder, they haven't answered the risk questions, you know, accordingly, or they haven't taken any steps to mitigate those risks, then who cares what the ROI is? So, you know, follow your gut, come up with your own list of 4 questions that are going to narrow it down. And then sure, absolutely use ROI as maybe a benchmark at that point in time, but just make sure those 4 very common sense things, just, you know, you're all real estate investors or being educated to do so. Just make sure they make sense to you, because, you know, and that's again why you want to work with an EMD. Make sure it's sitting on a platform, because I can guarantee you those 4 questions, 5 questions have already been answered by the EMD.
I love that. Sorry to jump in again, but I love that process and that sort of numbered way to look at it, because to me, that's why people are looking at real estate. If they're over here looking at real estate investment, that's why the ROI should be your last check mark. That's the whole edge of real estate. That's the whole reason why you're looking at real estate as compared to something else. If you're starting with the ROI and you're not concerned about the other things, the security, the process, the team, then you should be starting with crypto, because that's and that's fine. Take some money to crypto. There's nothing wrong with a little bit of crypto. But why are you in real estate if you're going backwards, right? That's that you're giving away your entire edge. So I love that you preface that way. You work them through that way, and make sure people are doing that, like they're really thinking about what they're doing and going through the steps. And remembering, why am I even interested in real estate investing to begin with? Why am I even here? I think you laid that out excellently. So I like the way you communicated that, because that's something we continue to try to communicate as well.
Yeah, it's super important, right? Real estate, yes, we're going to make money, but just like my point why I got out of the public market business is get out of the swings. Yes, real estate's going to go through cycles, and there's always going to be interesting bumps along the way. But, you know, especially in your situation, you know, you've got an already built asset, almost always fully leased up. It's cash flowing. You run your pro forma. It's going to take a lot to throw that off course. So there's lots of ways to mitigate kind of wonky markets, which is what we've been in for the last, you know, couple of years. Just don't, again, take the emotion out of it, common sense. If it doesn't feel right, it's probably not right. And just qualify the other things first and the offer.
Yeah, all good points. And the other thing to point out is there's a lot of peer-to-peer investing in the marketplace as well. And you know, these questions you can apply to any investment, but you also have to remember in a peer-to-peer investment is that no one is taking a look at all of this stuff, right? On behalf of the deal or the issuer or the project or the team. So if that risk mitigation is important to you, working with a group like RealShare helps a lot with that, because all of these questions are being asked all the time and updated continually as well. So I think, Rodney, did you have any other questions? That was my list of questions. Was there any others you kind of?
No, I think that was pretty concise. I think, like we said, the big thing for us is that when we're talking to people, that they get to know who you are, Ryan, and what you're about and your position in everything. You know, like we all said, there's a lot of these, you know, EMDs and, you know, REITs and all these different terms and things get thrown around, especially for new investors. So knowing who's on the other side of it, knowing why they're there, knowing that they're there to protect really all three parties. They're there to look out for WealthShare, they're there to look out for the investor, and then of course yourself. You can't stay in business, like you said. It was really important. Everybody needs to know the skin in the game aspect. You cannot stay in business as a company, RealShare, if you're going to back poor offerings and you're going to get behind the wrong issuers. So like it's very important that people realize why you're even there, what your position in all of this is, and that in the end of the day, it's there to protect the investor and the issuer as well. So I think that's like one of the big key things here is for people that are looking at WealthShare or other offerings, is that they get to know you and get to realize, you know, recognize the position in the whole process, right?
Yeah, no, I appreciate that. And, you know, for those who aren't interested with working with a DR or even myself right out of the gate, that's why RealShare was created.
Yeah.
You'll see it's a state-of-the-art platform. You can go check it out. You can go from opening an account to placing your first investment in as little as 30 minutes. You know, my job is, you know, get on there, see what you like. You're going to see something like with WealthShare, and then, you know, you reach out at that point in time and say, well, I'm considering these couple of things. What do you think? Can you help me break it down? You don't have to go through the process with us right out of the gate. There's some sophisticated folks out there that we never meet face to face, and that's the purpose of the portal and the platform, is for that more sophisticated investor, they can kind of control their own destiny and manage their own portfolio. But for folks who aren't sure and want to work with a professional, we've got a great team over there to do that. So invite you to check out realshare.ca, and if you have any questions, I'll be there to help.
Great. Awesome. Did anyone have any questions for Ryan? He isn't leaving yet, but kind of what I thought we would do next was I will open the WealthShare kind of slides and review them. And I thought what I would do is kind of point out some things to look at when you're comparing us with other groups, or some considerations to kind of apply what we just learned with Ryan. But if there's any specific questions right now, let me know while I am getting this. Hopefully Google cooperates. Can you see my slides? Yes. Zoom hates Safari now. I have to use everything on Google. So, okay. So, yeah. So what I thought we would do is we'll take a look at WealthShare. I can kind of provide an update of where we're at, what we're doing. We've got lots of exciting things going on. Oh, I got a chat message here. Ryan, could you speak more to the OSC? Do you mean, Patty, like what their role is, or kind of what they oversee?
Yeah, I guess in a nutshell, the Ontario Securities Commission, they're the ones that regulate us. So we have to do all of our legal and our reporting on our behalf. And we go through audits quite regularly with the OSC to make sure that our dealing reps are making appropriate notes, that suitability is aligned for investors. They will pull at any given time all of your investments for the last 6 months and say, well, let me see the financials here, and the questions that they answered accordingly, and was it suitable for Mr. and Mrs. Jones, and so on and so forth. So they're there to oversee, and they're there to regulate all of the exempt market dealers.
Okay. Someone just texted me. Oh, Patty said, signing a waiver if you go above the 10 to 15% rule.
Yeah. Oh, so you're talking about concentration. Yes. Yeah, I can touch on that. So it used to be a black and white, hard and fast rule. The OSC stepped in, and this was for all provinces. For those of you that don't know, all the provinces basically adhere to the rules of the OSC. There are a few different points in other provinces. They just use different languages around. You're either accredited or you're not nothing, but you're just deemed eligible. Anyways, not to get off track, but because people were coming to us with, or not myself, say they had $100,000 to invest, and they would put all $100,000 of their net financial assets into any one deal. Something goes wrong with that deal, they just lost all of their net financial assets. So they stepped in and said, hard rule is you can't go above 10% of your net financial assets in any one issuer. And that's, again, just to basically force diversification and to de-risk things. Now they've loosened the language. They've now referred to it as a guideline. But yes, this is a very good point, and this does happen all the time, is we can have a client sign a client-directed trade form, which says, and me as the DR would say, this is 18% of your net financial assets. I don't deem this to be suitable for you. However, if you want to sign this client-directed trade form, we basically pass the liability at that point on to you. I told you not to go above 10%, and 15 is a stretch, but now you're well above 15. So yes, at the end of the day, you can tell us to do it. Our compliance department doesn't have to accept it, but for the right product, like a REIT, maybe even a mix, something that's already diversified and a little bit more de-risked, most of the EMDs will allow that, but the likelihood of getting approved into a longer term development deal where there's construction risk and pre-sale risk and zoning risk, and there's just so much to go on, we won't go above 10%. It's even a rule just even at the EMD level.
Awesome question. Awesome question. Okay, I'm going to just dive into this, but if there's more questions, please feel free to throw them in the chat. I'm sure many of you have seen this, but as we move through the WealthShare slides, this is our beautiful disclaimer, which you can see at wealthshare.ca if you do want to read through it. And essentially what the point of this is not to necessarily, we're not soliciting your investment here this evening. We're having this conversation for informational purposes only. But if you haven't met our WealthShare management team, here they are up on the screen. I won't dive into our roles and everything like that because we don't have the time for that. But if you do want to interest, or if you have more interest in that, you can find more info on our website. But let's review kind of our offering just quickly as it relates to a lot of what we just talked about. So our offering is open to eligible and accredited investors, of course, subject to compliance with everything we just spoke about. So now we understand where the compliance rules are coming from. We understand the eligible and accredited definitions. And for eligible investors to be able to participate in what we're doing, we had to not just form the fund, but we also had to have an offering memorandum. So you hear that term too, OM, offering memorandum. And if there is no offering memorandum in place, we would not have been able to accept investment from eligible investors. So that's an important thing to look at. If you're looking at other opportunities and you are an eligible investor, that will likely change what you're looking at right out the gate. Second one, which we didn't really dive into tonight, was registered funds. We are open to registered accounts, which is something that we were very passionate about from day one. And it's really what took us down this path, was that so many of our investors want to use registered accounts, particularly because we are doing buy and hold real estate. It's a has less variables to it than a development, for example. And so there's a lot of comfort around and still investing in real estate with your registered funds, but into buy and hold real estate. Our minimum, and this is another thing as you're comparing to kind of check out, is what is the minimum investment? So our minimum is set at $5,000 intentionally. I do think we've been a trailblazer in this space. Before we were doing this, I don't think I saw one offering this low. And I like to see that because it makes it easier for people to diversify. It also gets people investing sooner into real estate. And it's only getting harder and harder to own real estate in this country. So I'd rather people dip a toe and start with something like WealthShare and get started. It also is great for the TFSA contribution limits annually that we have. And also, I'm always surprised at how many people have random numbers and random accounts of things. And so this way, we can accept all of that. So this was an intentional thing that we thought long and hard about when we started, and a lot of the other groups have followed suit. I do believe that we did kind of start that, which I'm really proud of, because it creates more opportunities. We talked about ROI, of course, and this is usually, like, you know, what Ryan mentioned, the first thing people ask, and but there's so much more to it. But we target an annualized 12% return. So we target 12%, meaning after every fee we have to pay, after every management fee and operating expense, we want to deliver a 12% annual return to our investors. That is comprised of equity growth as well as cash flow combined to create a 12% annualized return. We do offer an 8% preferred return. And what that means is us as the management team, we do not receive any sort of performance bonus for that year on the cash proceeds that are distributed to our investors, unless we hit an 8% preferred return. So we're prioritizing the investors first before we kind of see those bonuses on an annual basis or a share in the returns that year. We're on a continuous raise. We're growing a portfolio. As you look at other offerings, they may go, we need to raise X amount of dollars, and then we're kind of done because they're going to buy one building or they're going to do one development. We're aiming to grow a continual portfolio here. So there's no, like, once we hit this number, we're done, at least where we're at right now. And so as a result, there is no limited number of units available. Our unit price right now for this year is $11.10. We did come out of the gate in our first year at $10. So our investors did see an 11.1% return on their investment in 2023. So these are some key things to look at just as an initial sort of look when you're looking at these offerings, because they will have a summary often similar to that one. But real quick, I did want to talk about, like, what is a REIT? What is a mutual fund trust? When we started this 2.5 years ago, no one knew what that was. Now they are popping up all over the place. There is a lot of them. We had actually a really hard time even finding a legal team to help us in Alberta because it was so uncommon 2 years ago. Now it's very common. But really what it is, put simply, and why it's so attractive, is it's a way to pool capital towards a common goal. We are buying multifamily real estate, but it could be storage units or commercial space or whatever it is. So that's what we are doing. And it's the only vehicle in Canada that essentially allows us to tick all of those boxes that we just spoke about. This is the vehicle we're required to have in combination with the offering memorandum to be able to do everything that we are doing. And there's lots of kind of benefits and pros for the investors when it comes to this structure. And number one is that we are registered with the securities administrators, and also we undergo annual audits. So this is something to compare to when you're thinking about risk, and there's all different types of structures out there. If this, for example, was just a GP-LP structure, there's no annual audit required. But because we are regulated and because of the structure that we have, we do have to complete that annual audit. So annually, you as our investor get to see our financials that have been audited independently. And it's a very intense process that will only grow into a bigger project every year as we grow. but it's something that we're also proud of. We're proud that we go through this process and can provide that level of visibility to our investors. Also, for the investors, like we chatted about, you can use registered funds, which is a big thing. There's all kinds of tax strategies we could dive into. And, when you're talking about registered funds and, even just preservation of capital until retirement years or tax planning efficiencies, you can take into account your registered accounts when doing so. It also provides you access, which Ryan chatted about, to other type of opportunities you might not be able to, seek on your own, other geographic locations. You don't need to qualify for the financing. You don't need to go it alone. You are investing in assets that are professionally managed by a team that you believe in, that you can get behind, and also at the same time allow you to diversify in something without having to do all that work. So those kind of benefits all put together really are the large benefits for the REIT structure, in combination with the offering memorandum as well, if we're talking about the accredited versus eligible. So for WealthShare specifically, we are trying to remove as many variables as possible right now. WealthShare as a structure, we have one fund, which is our fund that we are talking about tonight, and we are doing buy and hold real estate. We are not developing, we're not doing big renovations, we're not doing things that have a lot of variables or risk, and that is very intentional. We want to walk before we run. If we do ever get into another strategy, we will open another fund. So if you invest in this buy and hold fund, it will always remain buy and hold fund. We're not going to now suddenly throw in some other, totally different strategy into this fund. But that's kind of cool. In the future, we have the ability to diversify with inside of the WealthShare umbrella, should we ever want to do that. But right now we want to do well in something that has less variables and deliver a good solid return, and prove concept with this team and the structure and everything that we have. So we are buying cash flowing, long-term buy and hold assets here in Alberta. We're focused here in Alberta because of all kinds of reasons that we all know when it comes to the economics, but also we're located in Alberta. And I've had a 15-year-long career as a commercial and residential realtor here in Alberta, and that has proved valuable to WealthShare. We have been able to get access to some great opportunities, and will continue to do so. And that combined with, just the Alberta climate, specifically around management, capabilities around the tenancy laws, is huge. And we have our management team here, so it only makes sense for us to create a good, strong foothold here in Alberta. I do get asked sometimes why we chose multifamily instead of other commercial asset classes, but it's a lot of what we've kind of been talking about of why we like multifamily. Financing is a big one. What you can do in the multifamily space in terms of financing options is limited to multifamily real estate. It doesn't apply if I want to go buy a gas station or a car wash. That proves very fruitful in Alberta. So we want to invest in hard assets because it's income, it's stable. We know we need housing. We know Alberta is attracting a lot of people and they need housing. And the rate of home ownership is only going down. That is just the facts. So we want to be part of that solution and provide good housing in good areas. Multifamily offers some pretty different benefits too, in terms of the amortization periods you can get. You can go up to 50 years. Loan to value requirements can be up to 95%. We do not have loan to values that high. We don't have anything leveraged anywhere near that, but that is a possibility. And it's just a very different qualifying process. The economies of scale in multifamily are actually quite exciting. That's probably what we're most excited about for growth, is those economies of scale get really, really great when it comes to insurance, utilities, even the cost per door really substantially comes down. And so that has a massively positive impact on the whole portfolio as we grow. Probably my favorite thing about multifamily, though, is the valuation of property is determined by net operating income. So it's really cool that you are basically in control of how your property is going to be valued by how well you take care of it. And this was the very first thing that we invested in at WealthShare, was a full-time in-house property manager, licensed, because it's not just about acquiring assets, it's really about taking care of them really, really well. And we've done a tremendous job that I'm extremely proud of on the property management side, and it paid off significantly right away. So as we grow, those efficiencies on the operational side will continue to expand. And that only has a positive impact on the net operating income, which also then, of course, impacts the valuation of the assets inside of the WealthShare portfolio. We get asked a lot about the MLI Select program. We do use the program when needed. We have one asset in the MLI Select program, and then we have one in the MLI Market program. In talking about risk tonight, and that is a really important thing to look at too, is how much is this portfolio that you're investing in leveraged? Just because, you know, there's X amount of assets under management, that doesn't necessarily tell you how much debt is in place either. So that's something to consider too when you're comparing, or possible questions to ask. Our debt to kind of valuation ratio is around 80% across all of our assets. So we are not highly leveraged, and we like that. If we do have assets that, you know, make sense to be highly leveraged, that's great, but we don't want everything highly leveraged at all times, because inevitably things are going to shift and move, and that's absolutely going to happen. I won't spend too much time on this. Everybody knows about Canada's housing crisis. It's not going anywhere. And so being part of the solution is something that we're finding a lot of our investors are really proud of, and they want to be investing in multifamily for that reason. And we feel the exact same way. So in talking about why Alberta, I mean, so many folks are excited about Alberta in the last few years. There's just, you know, truckloads of people moving here, and the housing isn't keeping up with those demands. So net migration, immigration are, of course, the two key economic indicators. And when you're analyzing passive investments, you know, we didn't talk about this, but just take a look at the economics as well, right? Like, where are the people going? That's what I always ask it, you know, where are the people going in a certain area, and does that make sense? So combined with the population growth, the regulations here in Alberta do benefit us as investors in multifamily, particularly when we don't have rent control. We can raise the rent once per year, how the market will bear. And also, if things do go wrong and we have tenants that are, you know, a risk to a unit, for example, the process to mitigate that is much quicker than many other provinces. And that alone, that piece alone is why people have moved their entire portfolios to Alberta from other provinces, because that risk is pretty huge when you have a tenant that you can't remove that hasn't paid rent for, you know, 6, 8, 9 months. That's a big problem when it comes to us wanting to be comfortable delivering returns to you as our investors. So that is a big thing. The quality of life in Alberta, I feel like more and more I'm hearing how much Ontario people in particular are mentioning like how excited they are to be in Alberta, and how they feel there is so much going on here, and they're really attracted to the lifestyle here. So couldn't be more excited for Alberta than I've ever been. And then just to add one thing that's not even on this slide is, because I get asked this a lot, is, you know, why Alberta? You know, we're a boom bust province and we've had these ups and downs. And though that is true for Calgary specifically, as the kind of the leader in this province, we have never, ever seen this much diversification in the economic side in terms of the people that we're attracting, the businesses that we're attracting. And it's really not just about the energy sector anymore like it used to be. Don't get me wrong, we are still heavily, you know, reliant on the energy sector, but it's nowhere near as commanding in terms of what we all require here to be successful, and what opportunities are available to people to make Calgary a very good home. So that is why I am confident in Alberta as a province and in Calgary and the opportunities we have. We're just getting started. So something we're very excited about. Now, I won't go into too much unless there's specific details, but when you look at our portfolio that we manage, this was the first asset that we acquired, Bergen, in Mission in Southwest Calgary. This is a 21-unit building built in 2020. This was our second acquisition called the Winston. This is 19 townhouses in Southwest Calgary, and you can see that they're both, in really good areas. They are attracting very good tenant profiles. They are new or newish. There's not a lot of variables here in terms of, the acquisition side. We outperformed our rents on both of these assets, as well as the most recent one, which was in Edmonton. And that is because we are conservative. Monique, our CFO, is extremely conservative, and it has proved extremely beneficial so far. So we always want to, be conservative, and if things can work there, great. If we do better, awesome, because there's lots of variables that can change. But on the assets we manage, we want them to be attracting good tenants in good areas. And our history in this province also does tell us in less kind of demanding times what areas maybe are less desirable, right? And these are properties that I know will be desirable no matter what the market condition is doing here in Calgary. So we did complete our first full year last year, and we delivered an 11.1% return to our investors, which we are very proud of in our first year. We didn't even have quite a full year. This is actually about 8 months in 2023. So as we mentioned earlier, that is a result of our audit that we did undergo, and we will be targeting a 12% return this year. And we are aiming to do a 3% cash distribution this year. There is some returns obviously on the equity growth side, as well as whatever cash is available. So for investors, whatever cash is available to distribute, we will do that by the end of the calendar year, every single year. And there's always the equity growth and cash flow. So whatever is available, we will do at that time. And then in 2024, this is our most recent acquisition, Stillwater. This was 16 townhouses in Southwest Edmonton, new construction, so easy to manage. We are having an awesome time with this property. We are completely fully leased up here. And we have 2 and 3 bedroom units. They all have garages, and we've just had a really good time leasing this property up. And there may be more coming in this community for us. We will see. But as it stands right now, we are just going through our CMHC refinance on this one, because we did have to get everything fully leased up, which we have done. So we are in the middle of that right now. We also have a targeted 12% annual return on this one, just like the other assets as well. So you can expect more of that with us. We do want to continue to diversify. We want to continue to grow. We will be looking at townhouses and apartment style buildings. We are analyzing several more acquisitions right now, but that does depend on capital raising as well. We also don't necessarily need to grow to X amount of level to make this year worthwhile for all of our investors. We're in a very good situation that way. But we do want and need to continue to grow as we set out for WealthShare. So we're looking at more in Edmonton and Calgary right now, and all similar type of assets that are new or newish, so we can take advantage of all the things that we just kind of chatted about. I know I've gone over a couple minutes, just a couple things to highlight. What you can kind of expect from us is we will be continuing doing these type of events. We like to provide value to our community and engage with investors and be leaders in this space in terms of providing accessible information and accessible opportunity. So that's really our main, value proposition is accessibility. So for the remainder of the year, we're going to continue on our fundraising efforts. We cannot do it without our investors. We are approaching 300 investors in the WealthShare community, which is unbelievable that in the last 2 years, we have seen that tremendous support, and we love it. We have such a good relationship with our investors and are just so proud to be, getting their hard-earned money to work. So we'll continue that through the year. And looking at next acquisitions. So quickly, last piece I wanted to point out when you're comparing opportunities is the fees. We didn't talk about that with Ryan, but this is a question I get a lot. Because when you go to RealShare, you're going to see issuer fees and dealer fees. So I like to point out, what does that mean? Issuer fees are us as the issuer. So we are the issuer. How do we get paid? How do we make managing this fund something we can do and actually keep the lights on? And this is something you can also compare when you're looking at us and other issuers, is what is their management fees? And usually there's acquisition fees, financing fees, and then management fees of the actual portfolio. As well as for us, we have this bonus that we talked about for anything over and above the 8% preferred return. So when we talk about a targeted 12% annual return, this is all taken into account. These are not fees that you are going to dish out, after your investment. This is all taken into account when we are doing our own analysis on these assets. And then dealer fees, why this is important. So Ryan is a dealer, an exempt market dealer with, or a dealing representative with an exempt market dealer, RealShare. And when you look at an offering memorandum, there'll always be an up to of what we as the issuer can pay for capital raising efforts. So now 6% is the max we can go. We have never actually had to go that high for any dealer fees up until this point. But if certain things come up, that could be what we are allowed to do. But this will be different in everybody's offering. So just a few things to point out to see if those align with what you are looking for. And then as we spoke about, maybe we'll put the link up of RealShare. But the process, if you want to take a look at our offering, is to go to the RealShare platform. All of the documents we talked about in terms of offering memorandum, the financials are on there for you to review. And then you can do the investment right from your profile. They will ask for ID. I've had some people go, well, they need my driver's license. Yes, they need to verify you are who you say you are and that you're have a proof of address here in Canada as well. And then all the signing and documents can be done with digital signing. So it's pretty easy that way. And they will walk you through the process if you do want to use registered accounts. Rodney, anything to add? Didn't want to keep people too long. I know.
No, I think that's covered everything that we needed to. Like you said, we don't want to run on too long, but I guess the only thing I would suggest is get over there, sign up for an account, even if you're not sure whether you're ready for an investment. That first step is part of the education. So sign up for an account, take a look at the offerings, not just ours, but some of the other ones, get some more information. You're not going to get hounded on things. But that's the best way you can really get into the meat of our offering and some other ones on there. Set up a call with Ryan if you're thinking about it. If you've invested before and you're looking to add an additional investment, this is a great time to take advantage of our growth projectile. But just start by getting the account set up and learning, get more education in there, understand the offerings, and then keep coming back for more of our events. We got it's looking like we might have someone from CMHC coming later this summer, and lots more really fun and educational online and in-person events. So just keep following up.
Yeah, we're gonna have in a few weeks in Calgary, for those that are here, I think it's July 18th and 17th now. I'm just gonna make sure I'm right. We're gonna have an in-person event at the Petroleum Club that we're gonna be releasing this week. July 18th at the Petroleum Club. It'll be like a networking event, a little bit of, we'll have some value add talk there, as well as networking, because it's always nice to see people in person. And this is a link to my calendar. If you want to speak to me directly, anything to do with suitability, risk, paperwork, any of that, all of that has to go to Ryan. But if you want to connect with me personally and talk more generally about what WealthShare's plan is, what our strategy is, what we're looking to do, I always want to connect with you and get to know you better and answer any questions you have. So that does send you to my calendar. And then there's our email there as well, if that's helpful too. Sure I didn't miss any questions.
Any questions? Yeah, if there's any other
Oh.
questions, now's the time.
Yeah. Okay, Patty said, Ryan spoke about the vetting process that is done by an EMD platform of the issuer. Explain 2 critical things the EMD does to vet the issuer. Oh, good question, Patty. Patty always has great questions.
Yeah, no, fantastic. First and foremost is obviously background check just on the GPs and who's involved and who's sponsoring the deal. The other thing that is critical, and whether it's considered due diligence or not, it's critical for any issuer to land on our platform, is we need to see a co-investment from the issuer that's coming on the platform. We need to know that they're not raising 100% of the startup capital, that they have absolutely no skin in the game. Some EMDs will allow that. That's not a problem. For us, no, we need a minimum of a 10% co-investment from the GPs or from the fund managers to land on our platform. Besides that, we go through any and all financials. We want to see all of those financials. We want to see all of the paperwork. We want to talk about, past history. A lot of it is just simple due diligence behind the scenes. That's not even a part of the due diligence package. Looking at past professional history and been involved in any deals that have gone well or not so well. So it might not be quite bank level due diligence, but it's darn near pretty close. A lot of the times is when someone's gone through bank credit and they've asked for information, we will ask for the same package. So
yeah, it was about a month of like back and forth with the team, and it is pretty in depth for a good reason. But that's a really good question, Patty. I don't think anyone has asked that one yet. Anything else? Sounds good. Thanks for coming in. All right. If there's no other questions, we can wrap it up. Sorry to keep 10 minutes over, but it was good to see you guys. We will send out the recording if you want to share it with anybody, or you have any questions, we'll send it out hopefully tomorrow. And if not, we will see you guys on the next one. Reach out to Ryan, reach out to me, let us know how we can answer any more questions you might have and support you on your investing journey. But thanks everybody for being here.
Have a good night.
have a good night.
Thanks, Ryan.